of that mountain of reserve of silver specifically, gold's not quite here yet, but of silver specifically, is now dwindling, and the market knows it. And so the physical markets, not only have they decoupled from a premium perspective over spot itself is breaking down. You're seeing the cracks in the dam of that international spot market, and it's crashing.
Here at Liberty and Finance, we're licensed brokers with Miles Franklin. We are standing by the inventory, ready to make sure you get what you need, even into the wee hours of night and on weekends, because preparedness doesn't stop. Call us 1-888-81-LIBERTY. That's 1-888-815-4237.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is our good friend Robert Kientz from GoldSilverPros. Rob, thank you so much for joining us today.
Thanks for having me on, Elijah.
It's great to have you. Now, you've recently stated that pretty much all the signs that we can see right now are pointing to a recession and a crash. Can you expand on this?
Yeah, one of the first things we're going to talk about is the yield curve. And as I've explained on my channel, the yield curve can invert. And when that does, it is the most common and predictable indicator of an oncoming recession within usually 6 to 12 months, sometimes a little bit longer. And what a yield curve inversion is when short-term treasuries need higher rates in the market or higher yields in the market to move than do longer term. And this is counterintuitive because typically over the long term, there's more uncertainty about what the economy could look like in, say, 10 years versus 2 years. So I think traders feel typically as though they know what the shorter term risks are going to be more accurately than the long term ones when different things can sort of pop up out of nowhere. So yield curve inversion is when the shorter term debt commands higher yields than the longer term debt. And that happened in the 3 year, in the 3, the 5 year, and the 7 year. It points in this week we're commanding higher rates than the 10-year. Now, the benchmark indicator for yield curve inversion is actually the difference between the 2 and the 10-year because of the 2 of the more popular debt issuances from the Treasury. But when we get the 3, the 5, and the 7 inverting and commanding higher rates than the 10, the 2 usually follows right along. So I'm going to go ahead and call that we have an official yield curve inversion, and that is signaling that we will have a recession somewhere in the next 6 to 12 or so months. And that's one data point. Another data point is essentially inflation has been running high. PPI came out this week. It's higher than you would expect on a normal basis. So we're going to have high inflation. And I would also point to the Fed, pulling away the proverbial punch bowl, raising rates this year. They've announced 7 total rate hikes. We think they're going to be a quarter point each. We know the one that should come in March is going to be a quarter point or at the beginning of April. And the rest we don't know. Some of the Fed governors are talking about doing a half point, which is quite a bit. So we'll be somewhere probably between 1.75 and 2.5% interest at the end of the year if these all hold true. And at the same time, the Fed is said they're officially going to taper. They're finally going to taper even though they haven't been, which means not purchasing as many securities and maybe also running off their balance sheet, meaning that they would actually sell some securities in the market. And Elijah, given that they're basically the highest marginal buyer of debt, this would be a big reversal in the bond market, and it should push up the yields even higher on the bonds and push that yield curve inversion even further along where it currently is.
No, it's interesting. We're seeing some counterintuitive action in the stock market. We're seeing a rally for the last week or so. Your take on this? Why do you think we're seeing a rally amid everything that's happening right now?
Yeah, you see world food shortages. You see the conflict in Russia and Ukraine. You see the bond yield curve beginning to invert, signaling a recession. You talk about the Fed raising rates and eventually dumping debt. Those are all things that should be causing the stock market to fall, not rise, because it's uncertainty economically and uncertainty geopolitically. Food security is probably the biggest of all these, honestly, because long term, if food prices continue to go up as they have been, according to current inflation trends, and people can't afford it, you could start getting riots. You could get people marching on Washington, D.C. again. You could get people showing up angry to the local town councils and things like that, demanding change at the state level and at the federal level in terms of either food subsidies or what the politicians are doing. So a lot of these things should be signaling much more risk in the market, and the stock market should be correcting, but they're not. And I just suppose that people are going to push up the stock markets until they can no longer go up. In fact, I've called for one more melt up in the stock market. I think this is going to be irrational exuberance, or basically people not letting go of the longest stock market bull we've had in history, dating back to about the 2009 timeframe. And I think people want one last hurrah, and they don't want to let go of the market that we've had, especially those that may be retiring now and need that to finance their 401ks and pensions, of which a lot of those are made up of stocks. So I think we're going to continue to see the stock market punching higher, people passively investing regardless of the fundamentals and regardless of what the bond market is telling them, until it can go no higher, and then we're going to have a crash. And whether that crash happens this year or next is anybody's guess. But I do think we're going to have another melt up. And I think the recovery we've had so far in the stock markets, basically dating back to the 14th of this month, have been that irrational exuberance. And I think it's just the start. I think we're going to hit sort of a massive punch up or a melt up, if you will, before the big crash comes. But I think all the other indicators are telling us that we're either, if we're not in a recession, we're getting very, very close to one.
I remember I was recently talking to David Hunter about a month ago, and he has been talking about this melt up for quite some time. And he says that it'll be very hard to resist jumping into stocks at that moment because there will be a whole narrative around it. And one of the things that he said might be part of the narrative is, kind of the moving away from the COVID restrictions, everything opening up and the economy fully reopening. And that's very bullish for the stock market. But at the end of the day, it looks like we're going to see a significant crash afterward. Your perspective on how maybe there will be this narrative along with this melt up we'll see.
Yeah, I agree with David Hunter pretty much almost in lockstep with his call. I know he's been at my conferences on our channel, and I have a great respect for him. He's been doing this a very long time, and I think he's correct. I do think the fundamentals are saying we're already in a recession, but they're not going to acknowledge it. And I think the mainstream media is built upon a rising stock market. That's what they talk about all the time. It's best for their investors and the people that sponsor those programs. To be honest with you, it's incentivizing them to continue to pump up the stock market. It's basically how they make their money. We don't have that problem, so we can, I think, tell more of the truth and get ahead of where the crashes are going to come and warn people. People are going to continue to do it. That narrative, it's a self-sustaining narrative. I mean, look at AMC when Wall Street Bets bid that up. It was a zombie company which had incredible returns for a while because people were getting in and pumping it up. And that basically is a microcosm of the entire market. People are going to pump it up because it looks good in their pension fund, their 401k. Companies need that to trade stock because it's how they finance their business. Also, stock prices are up, and company fundamentals are strong enough they can get more debt. So it's all self-sustaining until the point, Elijah, at which the fundamentals can't support it anymore. And what happens is you have this waterfall down, you have this big crash down where everybody realizes it, and the whole confidence game just sort of comes apart. And that largely is what most of these derivative markets are, the bond market, the stock market, even the US dollar. It's all a confidence game. And when people lose confidence, when they start to see reality, which I think they're starting to now, it's when that all comes crashing down. You got to remember about the stock market, not every share trades when the price is going up. If 1% of shares on average are trading on the S&P, which is about the normal in a given day, 1% of shares trade and the S&P goes up 2%. It's 2% of all the shares, not just the ones traded. So it's not like all that money went in to pump up all the shares. Okay. What happens is the marginal demand for shares drives the price for the entire, basically, reservoir of shares. And it's misleading as to the health of the market. That's why the stock market is basically decoupled from the economic fundamentals. People on the margins are trading the shares up. A lot of passive money is coming through the ETFs and pension funds. And that's what's bidding up the market. But it's not as though everybody's out there saying, we think Tesla needs to continue to go higher, Apple needs to go higher, IBM needs to go higher, these biotech firms need to go higher. It's not fundamentals driving them. It's the marginal trade on stocks and people wanting it to go up. And it doesn't take much. It takes about 1% of the market to say we want it to go up for the entire market to move up. But those are illusory gains because, like I said, it's not backed one for one with all the dollars going in. It's a marginal trading affecting the whole. So when it comes down, that's why water falls down. All that illusory value that wasn't backed dollar for dollar across the entire complex is going to disappear, basically. And that's where you get your big crashes.
And what kind of a crash are you anticipating?
Oh, I think it'll be like a 1929 type of crash. It'll be one of the worst crashes we've had in history when it finally happens. And the reason I say that is I chart things over big cycles. So we look at conjunctive waves over 80-year cycles. We look at nation state waves or empire waves, which are about 240, 260 years. And then we looked at economics across 700 years. For example, a statistic I've given out a couple of times on my program, if you look at the global bond markets, there has been a falling rate of interest on bonds for 700 years. So think about that, Elijah. This is before anybody came over to America, and built America, before we had markets. This is when the world was a much smaller place. Why have bond yields consistently over 700 years been falling to the point they are now? And what does that snapback look like? That's a snapback that has nothing to do specifically with the dollar, the pound, the euro, any of these fiat creations. This has to do with the way the world has assessed risk in its growth phase and its expansion phase. Well, now look at the economic fundamentals. We have people that don't have enough food. We have rising inflation. We have massive debt all over the world. Every currency is coming under pressure. We're having geopolitical concerns. We're having a massive fight for all commodities, not only food, base metals, things like potash and fertilizer. I mean, everything has kind of come into this point at which we don't have enough. And so that 700-year trend of falling bond rates has to reverse. You're going to see much higher debt to where it probably cracks that bond market, and that's going to lead a rout of the stock market as well. And I think you're going to have a big crash. And I think it could even be bigger than 1929 because I think it's going to be across the world, because I don't look at the economic fundamentals of any but maybe one or two countries and see them as being positive. I see them being overall net negative.
You've just mentioned food shortages, and it seems like also even here in the US, the percentage of people's income that's being spent on food is increasing significantly as we're seeing food prices increase. So your take on how that might get worse in the future?
We put out questions over Twitter sometimes just to survey our 14,000 followers and say, hey, what's affecting you? We got another one out today. And we ask questions like, what's affecting the most? And it's gas and food, or energy and food, that are causing the biggest harm to people's budgets. And people don't have the money. And they're selling things that they own. They're moving to smaller residences. They're moving in with their parents. They're even redeeming some other precious metals to, thank God they got into precious metals so that when we reach this period of inflation, they can get that value back out of them. But people who are unprepared are literally panicking. And the wage increases that we've seen have been much less than the increases in the prices of goods. They've lagged, and they always lag in this type of environment at the end of a debt cycle, at the end of a fiat currency cycle. Wage increases never go up with price increases. So we're going to continue to see a squeeze on both the middle and lower classes. It was funny that I think it was Bloomberg that came out with a tweet and an article that said people under 300,000 are going to feel the biggest pinch from inflation. Well, yeah, duh. 300,000 above is really sort of that 1.5% or top 1% of income earners. And when their stocks and their houses are rising, higher than inflation, they're going to feel rich. And yes, anybody under 300,000 is going to feel the pinch. But the bigger point is 300,000 used to be pretty rich in this country, Elijah. And that's not 300,000 doesn't include the middle class. The average middle class is probably about 60 to 100,000. So we're talking now inflation starting to creep into the upper income earners and affecting their budgets. That can't be ignored at all. And it's going to affect GDP. Another chart I had up on our channel recently, an article from Zero Hedge, all the stock markets and things like that, all the derivative paper markets have been inflated a lot over the last 20 years, but real tangible things had not, including housing, including things like gold and stuff like that. So real tangible assets haven't gone up as much as these derivative markets. When those derivative markets reverse because you can no longer support those valuations, one, money will flood back into tangible assets. But two, the people that only could afford tangible assets would have been behind. They wouldn't have had the benefit of those markets. And so what I think is going to happen is the big players in the markets that have a lot of stocks and all those derivative assets are going to sell them. And that basically would be a wealth transfer to them from the poor and middle classes. And I think that's what's coming. And that's why we recommend precious metals, because that takes you outside of that whole dynamic and allows you to store your wealth in precious metals and capture that money when it comes in. What you want to do is buy low, sell high. So, my recommendation is not to be at the top of the stock market buying, is to be selling at the top of the stock market and then buying into things that are cheaper, like farmland, precious metals, and things like that.
You talked about it a little while ago. You mentioned how in the stock market right now, it's only it just takes a few, like 1% of people on margin to make a huge impact on the price. And the rise that we see is not actually reflecting fundamentals. It's reflecting people buying on margin. And then if we just see a bit of selling, it can come cascading down. Do you see a similar dynamic happening soon in precious metals if we just see a small percentage of the population move in? And possibly if it is some of the larger traders on margin, we could see a huge rise higher.
Yeah, I think it's almost going to be, it'd probably be more than a dollar for dollar exchange from the stock and bond markets and precious metals. Because if you think about it, Elijah, a lot of people own stocks and bonds. It's that whole passive investing, 401k investing, traditional finance tells you to get into those sectors. And if you go to work and you have a 401k, you may have your choice of 7 funds. But if you look in detail at those 7 funds, they're investing in the same overall markets. It may be small cap versus large cap, but you're still in the stock market. It may be emerging market bonds versus U.S. bonds, but you're still into debt markets. And so that flows went in to push that up. And when that comes back, you only have about 0.5% of all the U.S. investment into precious metals. And around the world, it's a little bit higher, but it's only small percentage points. So when that money comes out of those markets, it's going to flood into precious metals. And people are going to panic when those other markets are going through the big crash, and they're going to bid the price of precious metals even into a bubble at some point. At some point, Elijah, I'll come on your show and we're going to be talking about the precious metals bubble and maybe even how to get out of it and how to, leverage your way out of that market to take your gains while saving some for the long term. And I think we're maybe a couple of years away from that, but that definitely will happen. The precious metals markets will be buoyed by people panicking out of and selling these other markets and looking for safe places to put their money.
And do you see a similar thing happening then with the miners as well?
Yeah, the miners are historically undervalued when you look at precious metals. So if you look at the recent bull market from gold, for example, from 2016 to now, the miners have not participated in that. I think the Hue and the GDX are somewhat like 60% below their 2011 highs. The last time gold, the first time gold hit 1900, and before it came back down. So gold and silver came back down to 2016, and the miners went with them. But then miners never rose 2016, 2022. So if you look at it from a ratio perspective, the miners, I think, are historically undervalued, at least for an entire generation, in my generation at least, and maybe dating back another generation, to when the boomers were first getting started investing. That's a huge pattern, and it's a buy signal for the market. Now, a lot of people are afraid to get in that market because it's low priced and it's priced below the net asset value of the metals in the ground, meaning it's like going and getting gold for pennies on the dollar because they're going to mine it, they're going to make money, and you're getting it for a fraction of what that gold is actually going to bring later, even at current prices. We're not even talking about when gold and silver get in the next leg of the boom. So it's a cheap way to get gold. You're all taking on some risk there because it's speculative, but it's a historically cheap way to do it. But the mainstream media won't talk about it because it's not in momentum. The only time the mainstream media will talk about stuff is when it's in momentum. So after that market gets raging, the precious metal market gets raging, they'll come back and say, oh, yeah, we told you all along this is going to happen. Of course, they didn't. So I wouldn't listen to mainstream media. I would look at the fundamentals of the market. And the fundamentals of the market are telling us that the miners are historically undervalued, and they're going to snap back. They're making a lot of money right now. They're having good earnings reports. And when that money comes out of, say, growth in tech stocks and is looking for a safe place, people's portfolios are going to come to the mining sector because it's historically undervalued. People are going to go back to value investing. The Peter Lynch, Warren Buffett way of investing is going to come back in vogue at some point.
And when it comes to the physical metal of gold and silver, at Miles Franklin, we're having huge supply issues right now and delays on product. And I know you've heard a lot about this as well. What are you seeing on your end when it comes to the supply of silver and gold? Because I remember a few months ago, you said it was condition red for the supply of silver, and it's just gotten worse from there. So your take on that right now?
Yeah, I was right in the condition red call. I know some people mocked that a little bit and said, yeah, Rob, we've been saying this for years, but I think it actually has happened. The above ground stockpiles are dwindling. You look at them on COMEX, it's maybe 40% of what it was a year and 3 months ago, 15 months ago. Part of that was due to silver squeeze a little over a calendar year ago, but the continued buying of the physical after that. And I talk with a lot of suppliers. I talked with Andy from Miles Franklin. I was out in San Diego with him last week, and we had a really long conversation face-to-face over this and what he's seeing. And I have other friends that are also have run precious metals businesses. And what we're seeing, Elijah, is the spot market is no longer, the spot price is no longer determined by COMEX in London, by the U.S. in London. What's happening is wholesalers have their own spot metal prices, and they can be 20 to 30 cents difference or even more on certain products. Why? Because one wholesaler may be better at getting bars than rounds. One wholesaler may be better at getting eagles versus maples. And so you're seeing the real dynamics of the actual availability of each silver and gold product commanding different spot prices, not premiums only, Elijah, but spot prices. And what that means, Elijah, is we have a fractured market. You cannot at this point determine the value of precious metals with two large international derivatives markets and where traders convene, because availability of certain products is different across different parts of the market. And it signifies that all of that mountain of reserve of silver specifically, gold's not quite here yet, but of silver specifically, is now dwindling, and the market knows it. And so the physical markets, not only have they decoupled from a premium perspective over spot itself is breaking down. You're seeing the cracks in the dam of that international spot market, and it's crashing. And I think that, coupled with the LME, debacle, and nickel and their inability to control that market, is really affecting the credibility, specifically the London OTC market. And I think what we're seeing in the physical market is going to eventually crack the credibility of the COMEX here in the U.S. And you see those signs, and it really means that things are moving along, and we really are in a deep shortage.
I just try to think of what it's going to be like when we see a bubble in gold and silver. Because right now, I mean, if you look at the charts, it's not too dramatic what we're seeing. We're seeing sideways action in silver. Yeah, gold just touched an all-time high, but nothing's really broken out yet. When we do see that breakout, I have no clue what kind of supply of physical silver is going to actually be out there.
I think what's happened in silver, if you look at the Commitment of Traders report, it's almost an even trade now. There's still a net short in silver. I think last time I looked last week, last week's data will come out this week, and I'll look at it by the end of the week. But it's almost even in silver. So you used to have massive shorts, and now not so much. And in gold, they're slowly liquidating short positions. So I think the derivative market has kind of figured out where we've got bull market conditions here. And I think they know that the price is going to go up. And I think we're early days on that yet, though. I don't see the sign that they're about to, silver's going to 50. But I do think we'll get there. And I think it's going to be highlighted by a strategic physical shortage of silver. Why, Elijah? Silver's used everywhere. Phones, military, computers, everything, medical devices, silver's everywhere. And if we have more geopolitical issues that leads to more hot wars, tons of silver is used in the military. The demand is going to be outrageous. I was just talking with a friend of mine who said we actually replaced nickel in nickels during World War II with silver because nickel was needed for armaments. Well, now we can't do that. We can't replace nickel with silver. So what are we going to put in our coins? We're running out of metals to put in the coins to eventually we may not have coins. And because not only are the precious metals getting more precious, Elijah, the base metals are getting more precious. And so that's really where we are. Now, is it going to happen tomorrow? Probably not. But are we at a point which we can confidently call the fact that there's a severe shortage of silver? Yes. And that, yes, we're going to see a bubble market, and it's going to go to levels of which we've never seen. But first, the credibility of those derivative markets I talk about in London and the U.S., have to be affected, and they are. We saw what happen with the LME. I think more people are questioning the trades on the COMEX as that awareness builds. And again, it's a confidence game. All derivative markets are a confidence game, and it's going to happen fast when it happens. The markets are the people are going to stop believing in the markets when they stop believing in the markets, and it will happen literally overnight. It's a slow build, and then it's a cascade down to where everybody says, oh, yeah. I mean, we don't believe that market. And when you see that being talked about on CNBC, that's when you know, and your cab driver's talking about, that's when you know we're there.
I think it'll be very interesting to see where this all heads. Robert Kientz, we really appreciate your insights as always. Before we let you go, where can our viewers find you online?
They can find us at GoldSilverPros.com and on YouTube and Twitter at GoldSilverPros. And look out for us on other platforms as well. We're building out some more as we speak.
Any last thoughts before we let you go?
I would just say, as I always say, I'm a perma bull, at least in the short to medium term on the precious metals, unabashedly so. And I think if you want to have hedges outside this big derivative-based system, which I think is beginning to its collapse, then I think you need to own some precious metals. Of course, talk to your own financial advisor. But for me, I'm probably now 70% of my wealth is in precious metals, 30% other like farmland and other things, other business investments. But I'm so heavy into it because I think we're about to hit that next big bull leg. Of course, decide what's right for you and, make your decisions accordingly.
All right. Once again, Robert Kientz, thank you so much for your time and God bless.
Appreciate it, Elijah. Thank you.
Miles Franklin Precious Metals is one of America's oldest and most trusted bullion dealers. Miles Franklin is A+ rated and accredited by the Better Business Bureau, licensed and bonded, and has 0 complaints ever registered. Here at Liberty and Finance, we are licensed brokers with Miles Franklin. To order, simply call us, discuss your needs, and we will let you know our live inventory, prices, and availability, and lock in your order over the phone. Once your order is locked, the price is held for you regardless of market fluctuations, and the metals are reserved for you awaiting your settled payment. Within 1 business day of ordering, you will receive an email invoice detailing the order and payment instructions. Miles Franklin accepts payments by bank wire, ACH or electronic check, money order, check mailed priority mail, and cryptocurrency. The fastest forms of payment are bank wire and cryptocurrency. Upon settled payment, metals will ship out within 3 to 5 business days. You will receive tracking information via email. Domestic shipping charges are $15 for any order under 500 ounces of silver or 10 ounces of gold. For orders larger than that, domestic shipping is free. The package will be double boxed, fully insured, and labeled discreetly, with no indication of the contents inside. For your privacy, the name Miles Franklin will not even be on the package. To talk to myself, Elijah, my brother Kaiser, or my father Dunnigan, call 1-888-81-LIBERTY. That's 1-888-815-4237.